Let's bring in Kathy Lien. She's Managing Director of FX Strategy at BK Asset Management. Eric Marshall is co-portfolio manager of the Hodges Small Cap Fund. And CNBC senior economics reporter Steve Liesman is here so that everybody can talk.
1931, actually performed by Pete Seeger, but written by a woman named Florence Reese relative to the Kentucky
perform it in 1931.
miners' strike. No.
But it's funny.
Pete Seeger sang it.
The date of that, and I don't want any comparisons to 1931 on a
Good
day
idea.
We're down 600 points, Steve. Why don't you tell us what intensified the selling pressure on a payrolls report that was frankly not terrible?
It's not terrible. It is slowing down. And look, people just don't have a sense of the bottom here. There was a bit of a debate in the last hour as to whether or not ISM manufacturing was bottoming. One economist said it is. Most economists I talk to say it's not. There's no indication of bottoming. You've had these 2 months in a row of contraction in manufacturing. You've got global economic weakness. You have a decline in confidence among CEOs and a decline in confidence among consumers. And those are reasons for concern. All of that said, the current track of the economy in our CNBC Rapid Update, which gets a median of all the tracking forecasts on the street, 1.9%. So not too far off for the third quarter. The outlook for the fourth quarter we just printed yesterday, 1.9%.
Where are we on the rate cuts, though, now? I mean, are we fully priced in October yet?
We have just about fully. Depends on what you consider to be fully. 71% or 72%, I consider that to be darn near fully priced in. And that was a big change from yesterday.
Yep.
Before that ISM number, it was down below 40.
Eric, a lot has changed since yesterday morning, which should remind us that we're only talking about 2 days worth of data, but still a very poor start to the month. Now we haven't had a 3.5% back-to-back sell-off since the Christmas Eve sort of flush out lows from last year. Does that mean we've already kind of jumped ahead to the conclusion of this bout of selling pressure, or is this only just starting?
Well, we think a lot of negativity has been priced in. We don't think anything on trade resolution, for instance, is priced into the market at this point.
Well, should we expect trade resolution? I mean, it makes sense for people to stay skeptical.
Probably not. But, we spent a lot of time talking to CEOs and CFOs of companies at the Hodges funds. And what we've been hearing is a lot of uncertainty related to supply chain disruptions within certain segments. Not all of the small caps are being affected by this. But we've also heard that things are relatively tight on the labor markets, and companies are still hiring, but it's getting harder and harder to find those skilled workers.
And this is what's so fascinating about it is you can argue that in multiple ways. You can say, well, the labor market's so good it can only get worse from here. You could say the labor market's so tight it's slowing the whole economy, but it's pretty clear that's not, what's happening from the manufacturing and trade momentum piece of it. Kathy, what do you think is going on here? Is the data just catching up to the manufacturing story, to the trade issues, or is there something deeper in terms of the business cycle going on here?
I think for most of December, investors have been operating on a decoupling theory, where they think that the U.S. economy is going to accelerate or recover or gain momentum in the second half of the year as the world continues to slow. And I think what this week's data has shown us is that the deceleration is going global, and the U.S. is certainly not immune to it. And there's a very good chance that in the coming months, we're going to see even further weakness. And I think that's really finally hitting home, because for most of the month, the market had anticipated the Fed to pretty much be done, especially after the voting record for the last FOMC. But as Steve just pointed out, there's a Russian expectation. So yes, I do think that there's more trouble ahead, and that's what's reflected in the U.S. dollar as well as U.S. markets.
So Kathy, if you think, especially because the currency piece of this is interesting and it's been frustrating to the president, who keeps saying he wants a weaker dollar and blaming the Fed for it and so forth. If you think we're seeing further weakness for the U.S. economy, what does that mean for the dollar? Does it get stronger?
Well, politics aside, I think, first and foremost, at the onset, we're going to see a continued U.S. dollar weakness because a lot of the other major currencies have become deeply oversold. And there needs to be some sort of sentiment adjustment for the outlook for the U.S. economy. But at the end of the day, though, I think there's still going to be a safe haven bid and attractiveness that draws investors into the dollar, because while the U.S. may be feeling the pain, the rest of the world is going to sink harder. And I think, that's really the long-term trajectory. But in the near term, though, I think, just from positioning perspective, as well as ahead of NFPs, we should see a reversal.
Okay, that's super interesting if the highs maybe are in for the year in terms of that dollar. Steve, I also don't want to gloss over what's happened in terms of the Bernie Sanders news today. We'll have more on this later, but if you look at someone like Art Cashin, who says the last couple hundred points of the sell-off might be because of this health scare he's had with getting stents inserted and so forth, Elizabeth Warren becomes a stronger front runner, and markets knee-jerk don't like that prospect. You think there's something to that here?
Perhaps. I can't play that game. I have no data on that. I'm always afraid when the market gets a vote. I think that's disruptive to our democracy when people come forward. And let's be clear, the experts were in academia and in the market were wrong about Donald Trump. There was a very academically research piece about how the market would price in a Trump victory. It ended up being dead right for 2 hours,
when
and
we had the
dead wrong for the last 2 years.
Exactly.
So I'm always afraid of it. I'm always afraid that the market takes the politics as they are. I would not argue with Art Cashin. He's smarter than I am and has more experience by several light years. So I would just say to be very careful with that. I would say this though about recession, which is I don't think we're on the express train to recession. I think there are some stops along the way. I think that Kathy was talking about the idea of slower growth. You could run for a while at least below trend. That's a possibility. You could also have, because some of the problems that are out there, and John Williams talked about this today, the New York Fed president, that we're in uncharted territory when it comes to monetary policy and trade. This trade problem could potentially go away. And that would lift a huge veil over the market and the outlook.
It's up to the president, though, what he means by that.
For 18 months under this trade war, the market has gone sideways. And every time we've been up near one of these all-time highs, it steps back. And you just don't know if lifting this trade veil would create a certain clarity that would allow for investment into the future.
Absolutely, Eric. One of the ways people kind of try to hide on days like this is go to the S&P low volatility ETF. Tends to outperform, and that's true today, although not to a major extent. What should investors do in the kind of environment that Steve's describing? It's neither 3% growth, nor is it a recession. It's 1.5% or 2% growth.
We wouldn't be surprised if we didn't see a slowdown similar to we had in the early 2000s, where you really have kind of a manufacturing industrial recession, but the consumer does relatively well. We still see consumption trends looking pretty good. There's favorable demographics and also lower mortgage rates we think will be good for things like housing. So we think that there are some pockets where you could find opportunities in this sell-off.
And you think it's okay to stick with that? Because people will say, well, the Lennar CEO today had some very bullish comments on their earnings call. He said the conditions are strong for us and they're improving. So for people who say, well, wait a minute, I don't want to go to some place where things are about to get worse, you say the strong parts of the economy can stay strong.
Yeah, and within our universe of small cap stocks, we're finding opportunities in some of those like home builders, and especially on the entry-level side, some material companies. And there are pockets of beaten-down consumer stocks that we're actually finding opportunities that are less impacted by what's going on with trade right now.
All right, Kathy, just going back to the question about more Fed rate cuts. So what do you think is priced in now? As Steve mentioned, it looks like the market is kind of pushing us towards almost certain expectations of a rate cut in a couple more weeks, and then what?
It's highly unlikely, I think, Kelly, because while the market's pricing a 70% chance, even if we get an ugly NFP number, the fact that we had so many dissenters at the last meeting and the dot plots showed they aren't convinced, I don't think one NFP number is going to be enough. So I think, there's a good chance we could see the dollar recover after non-farm payrolls. And I'm not a buyer into the Fed rate cut in October story.
Wow. All right.
There's no way for the dollar to adjust here correctly, because more economic weakness probably pushes more people into the dollar, which in turn would hurt exports in the manufacturing sector.